What if the biggest silver move of your lifetime isn't being driven by demand at all, but by a crack forming inside the system that's supposed to control the price? The financial networks are running their usual ticker parade. Green here, red there. CNBC is chatting about tech stocks. Bloomberg has another talking head explaining why the markets are resilient, but there's an eerie quiet about what's happening right now in the metal sector. I've been a private commodities analyst and physical silver stacker for over a decade. I built this channel using this AI avatar for one reason. I'm tired of spending half a day wading through mainstream coverage just to catch up with what my feeds show me in real time. And honestly, I'm tired of other AI channels pumping fake hype about silver when retail investors need real information. Before we go further, if you want clear, no-fluff breakdowns like this as events unfold, tap subscribe and turn on the notification bell so you don't miss the next update when the story shifts fast. So here's what they're not telling you. A criminal investigation was launched into Jerome Powell, the chairman of the Federal Reserve. Yes, the man tied to the money printer. And I'm not talking about a polite review or an ethics committee slap on the wrist. The Department of Justice is investigating him over his 2024 congressional testimony and office renovation expenditures that apparently raised red flags. The media is framing this as some minor volatility moment for metals. They're telling you the Fed is still independent, still steady, still the firm hand on the wheel. But the physical silver market just told you something very different. American Silver Eagles, the benchmark 1-ounce coin every stacker watches, just crossed $100 at major dealers. Not spot. Spot is sitting at $85.55. I'm talking about what you actually paid to get physical metal in your hand. $100. That's not a typo. That's not a quick spike. That looks like a new floor for physical silver. And it happened in about 48 hours. For the first time in my career, the gatekeepers are being investigated by their own Department of Justice, and the physical market just called their bluff. The Fed opened Pandora's box, and I don't think they're going to like what's inside. Here's my primary claim. I'm going to spend the next hour proving it with data, math, and real market mechanics. The DOJ's criminal probe into Powell shattered the illusion of Federal Reserve independence. That trust break triggered a massive safe haven flight into hard assets, and that flight caused the physical silver market to decouple from the paper exchange. We're not trading a normal commodity anymore. We're trading a crisis proxy. I'm going to walk you through what I call the premium gap mechanism. I'm going to run the stress test math on these $100 Eagles, and I'm going to show you exactly how I'm positioning my personal portfolio to survive what looks like a shadow war between the Federal Reserve and the Department of Justice. If you think $100 is the ceiling, you haven't seen the data I'm about to show you, because there's a rumor circulating on the institutional desks right now about something called the LBMA short squeeze. And if that rumor is even partly true, we're not talking about $100. We're talking about $150 in hand, while your screen still shows $100. Let me give you the snapshot. I pulled this a few hours ago at 2 p.m. Eastern Standard Time. Gold hit 4,610.54, a new all-time high. Silver spot closed at $85.55, up over 7% in a single session. That is a huge single-day move for silver. But here's where it gets strange. While spot was printing $85.55, I opened up APMEX. Then I checked other major dealers. Across the United States, brilliant uncirculated American Silver Eagles moved to $100 or higher. Some were listing at $102, $105. Smaller regional dealers were even higher because they were scrambling to restock from wholesalers who were already out. Stop for a second. Look at that gap. Paper says $85. Physical says $100. That's roughly a 17.5% premium. In a normal market, Eagle premiums run about $3 to $5 over spot. Maybe $8 if supplies tighten. 17% isn't tight. 17% is a divorce. And the inventory situation is what really grabbed my attention. I have a contact at a mid-sized dealer in Texas. He told me this morning his weekend order volume was 4 times a normal Saturday. People were buying anything they could get. Eagles, maples, generic rounds. It didn't matter. They just wanted physical silver before the psychological barrier of $100 scared them off. So why is physical running so far ahead of the screen price? Because of a mechanism most investors don't understand. And if you don't understand it, you're going to get fleeced by headlines over the next few weeks. Let me pull it apart. The key mechanism is physical versus paper decoupling. I call it the premium gap. It's the divorce between futures contracts traded on the COMEX and the physical metal you can actually. That's where we are with silver. COMEX is telling you $85, but try buying physical at $85 and you'll get laughed out of the shop. The real price, the price you actually pay to acquire metal, is $100. And here's the trap. If you only watch the ghost price on the news, you won't understand why your local coin shop is empty. You'll see spot dip to $80 next week and think, Great, silver's cheaper. But the dealer might still charge $95 or $100 because physical supply hasn't returned. The paper market gets held down by institutional players who benefit when the price stays low. But the physical market is doing something else. Price discovery. It's showing you what silver is really worth when people want to hold it, not just trade it. And that gap is growing because of a rumor leaking from institutional desks right now. I heard it from two separate sources, both tied to market firms you've heard of. The rumor is this. A major London Bullion Market Association vault is staring at a delivery default. The buyer could be a sovereign wealth fund or a central bank placing a massive order for physical silver, and the vault can't deliver. They don't have it. They sold paper claims on metal they didn't own, and now someone called their bluff. We can't verify this rumor. I don't have a source inside the LBMA, but the premium explosion we're seeing lines up with what a delivery squeeze looks like. When institutions realize they can't get metal at paper prices, they start hitting the physical market, and that's when retail investors like you and me get priced out. Now let's run the math. I'm going to give you two scenarios, a conservative one and a stress test one. You decide which is more likely. Conservative scenario. Assume the premium gap stabilizes at 17.5%, where we are right now. If spot silver keeps climbing and hits $100, simple math says physical eagles would be priced around $117. You'd pay $117 to get a 1-ounce coin while the screen says $100. That's the cost of scarcity. Stress test scenario. If the LBMA short squeeze rumor is true and delivery fails escalate, premiums could hit 50%. That sounds insane, but it's happened before in other commodities during crisis periods. A 50% premium on a $100 spot puts physical at $150 in hand. You'd be paying $150 while your TV still tells you the price is $100. Let me show you why that stress test isn't as crazy as it sounds. I was looking at technical indicators a few hours ago. The relative strength index for silver is at 77.9. That's overbought territory. Historically, when RSI gets above 70, it's a warning sign a pullback could be coming. Traders see that and think, sell, take profits, wait for the dip. But physical demand doesn't care about technical indicators right now. RSI is screaming overbought, and dealers still can't keep inventory on shelves. That tells me this isn't a normal technical rally. This is fear-driven accumulation. People aren't buying silver because they think it's going to $90. They're buying because they think the financial system is cracking. Here's another data point that doesn't fit a normal environment. The US dollar index, the DXY, is showing resilience. It's not collapsing. Normally, when the dollar is strong, precious metals get crushed. That inverse relationship is the Econ 101 story. Strong dollar, weak metals. Weak dollar, strong metals. But right now, both are rising. The dollar is holding up, and gold just hit an all-time high. Silver is up 7% in a day. That doesn't happen unless this isn't a simple currency trade, unless this is a liquidity black hole event. Money is fleeing into anything that feels safe. Dollars, gold, silver. It's not one trade. It's an escape from risk assets. The numbers don't match the history books because the history books didn't account for a Federal Reserve chairman under criminal investigation. That's the variable nobody priced in. Fed independence was always a myth, but it was a useful myth. The system stays stable because people believe the Fed is above politics, above corruption, above reproach. That belief is cracked now. And once trust disappears, price discovery gets violent. I know what skeptics are going to say. I've already seen it in comments across other channels. So let me address the strongest counter-argument head-on. Skeptic argument number one. This is a politics-induced blow-off top. RSI is stretched. Once DOJ headlines fade and the investigation turns into nothing, silver will crash back to $70. It's just retail hype driven by fear-mongering YouTubers. Here's my rebuttal. I'd agree with you if this were purely retail-driven. Retail can't move markets of this size for long. Retail doesn't have the capital. But this isn't just retail. I saw a Morgan Stanley research note that came out Friday. Their commodities theme flipped toward metals. They're now telling institutional clients to buy silver as a fiscal risk hedge. When big banks start telling clients to buy the thing they usually tell them to ignore, the floor moves up. Morgan Stanley isn't a silver permabull. They don't love silver. They love making money for clients. If they're rotating into metals, here's what I'm watching. Institutional reaction, specifically the COMEX. When the paper market starts losing control of price discovery, the exchange often does what it always does. It hikes margin requirements. That forces retail traders who are long silver futures to either post more cash or close positions. It's how they shake out weak hands. And it works. Every time margins hike, you often see a temporary dip as traders liquidate. I expect the COMEX to announce a margin hike within the next week, maybe 2. If they do, spot could pull back to $80 or $75. Financial media will say, see, rally over, silver's crashing. But if you understand the mechanism, you'll know the paper dip doesn't automatically mean physical follows. Dealers might shave premiums a bit, but the $100 floor may be sticky now. I'm also watching the gold to silver ratio, the GSR. This is the number of ounces of silver it takes to buy 1 ounce of gold. Right now, with gold at $4,600 and silver at $85, the ratio is about 54 to 1. Historically, the long-term average is around 60 to 1. When the ratio drops below 50, it usually signals silver is outperforming gold. It means silver mania is starting. If we see GSR break 50, I'm expecting a face-melting rally. The kind of move that gets normies asking financial advisors how to buy coins. That's when it gets dangerous. Not because silver must crash, but because premiums can go parabolic. You can see 40% or 50% premiums when retail panic buying hits. The media response is going to be predictable. Expect coordinated silence at first. Major networks won't cover the silver story because it's inconvenient. It raises questions about Fed credibility, central bank manipulation, and system stability. Those are topics they avoid. When they finally cover it, they'll call silver a meme metal. They'll compare it to GameStop and AMC. They'll bring on an analyst to claim it's retail speculation driven by social media. They'll do everything they can to discourage the masses from buying. And that's exactly when you should pay attention. Because the media's job isn't just to inform you, it's also to manage behavior. Now let me tell you about the wildcard scenario. I call it hike to spike. There's an unverified rumor circulating that the Fed might hike rates aggressively this year, not to fight inflation, but to crash the economy and undermine the DOJ investigation. The logic goes like this. If Powell faces criminal charges, his best defense is to show that removing him or weakening the Fed would be catastrophic for markets. So he engineers a controlled crash, blames political interference, and uses chaos to rally support. I don't know if that's true. It sounds like conspiracy talk. But the Fed has done stranger things. If it is true, we're entering extreme volatility. Rate hikes would crush equities and real estate, but they might push gold and silver higher as people flee into hard assets. The playbook gets messy fast. So in this chaos, what am I doing with my own money? Let me give you my personal battle plan. This is not advice. This is what I'm doing. Do your own research. Make your own decisions. Trigger number 1, the $80.50 support test. If spot retraces to $80.50 and holds, I'm treating that as structural confirmation to stay aggressive. It suggests the rally has legs and dip buyers remain in control. If it breaks below $80 and keeps sliding, I'll lighten up. I'm not trying to catch a falling knife. Trigger number 2, the 25% premium cap. If physical premiums hit $106 while spot stays around $85, I'm personally sitting on my hands. I refuse to pay a 25% panic tax to dealers. At that point, risk-reward looks broken. I'd rather wait for premium compression or for spot to catch up. Trigger number 3, GSR at 50. If the gold to silver ratio hits 50, I'll look to rotate a portion of my silver gains back into gold. Not because I'm bearish on silver, but because I want to lock profits and rebalance. Silver is more volatile than gold. When it runs harder. When it crashes, it can crash harder too. I don't want to be the guy holding the bag at the top. Here's my personal stance. I'm not buying the ghost price. I'm not making decisions based on what the screen tells me. I'm watching real-world shop availability. If supply vanishes, the price becomes secondary. You either have it or you don't. And if you don't have it when the system breaks, good luck getting it at any price. I'm using conditional if-then logic. If the Fed caves to the DOJ and Powell resigns or gets removed, expect a short-term dip in metals because the market reads it as resolution. Here's why that matters now. The Fed and the exchanges have a playbook. When silver starts threatening the system, they change the rules. They don't let the market run free, they intervene, and they always justify it as stability and preventing manipulation. If we see a repeat of the Hunt brothers dynamics, you need to know what it looks like. First, margin hikes on the COMEX. Second, delivery restrictions, like only allowing delivery of a certain amount per month. Third, coordinated media attacks, calling it a bubble, irrational, manipulated by retail. The goal is to scare you into selling, and it works on most people. They see a 20% drop in 3 days and think it's going to zero. But if you understand the playbook, you see the dip can be artificial, not driven by fundamentals, driven by rule changes designed to break momentum. Now let me contrast what's different this time. In 1980, the Hunt brothers were easy to paint as villains. 2 billionaires trying to corner a market for profit. But in 2026, buying isn't coming from 2 people. It's coming from sovereign wealth funds, central banks, pension funds, and retail investors terrified by what the DOJ investigation implies for dollar stability. You can't realistically call that two guys manipulating. Demand is decentralized. It's global. It's driven by loss of trust. That makes intervention harder without looking like the game is rigged. There's also a geopolitical angle. I'm seeing reports that China and Russia have been accumulating gold and silver reserves for years. If they smell blood in the water, if they think the U.S. financial system is weakening, they may accelerate accumulation. That adds pressure to physical supply, and it turns the silver market into a proxy battleground for a larger economic war. And the U.S. isn't the only country dealing with a credibility crisis around central banks. The European Central Bank has been under fire for years. The Bank of Japan is trapped in zero-rate policy and can't escape without risking the bond market. China's economy is slowing. The global monetary system is under stress. When central banks lose credibility at the same time, the flight to hard assets becomes a stampede. It's not just Americans buying silver, it's Europeans, Asians, Middle Easterners, anyone with access to a dealer trying to get physical metal, and the supply is finite. That's why I don't think physical paper decoupling is a temporary glitch. It can become the new normal. As long as trust in the central bank is damaged, the premium gap can persist. You pay more to hold physical than to trade paper. And that premium is the price of certainty in an uncertain world. Let me give you another layer of the COMEX playbook. It's not just margin hikes. The exchange can implement position limits. They cap how many contracts any single entity can hold. They claim it's to prevent manipulation. But it also prevents large players from forcing delivery. If you own 10,000 silver futures contracts and each is 5,000 ounces, you can demand 50 million ounces. That's huge. If COMEX doesn't have it in the vaults, they're in trouble. So they cap positions at something like 1,000 contracts. Now delivery demands are smaller and more manageable. Watch for position limit announcements. If COMEX suddenly tightens limits on silver futures, it's a signal they're worried about delivery stress. And ironically, that can be bullish for physical, because it's an indirect admission the paper market is fragile. Here's another scenario I'm watching, even if it's not the base case. The US has the Strategic Petroleum Reserve. What if the government decides it needs a strategic silver reserve or a broader precious metals reserve? They could justify it as national security. Silver is used in electronics, solar, and weapon systems. A shortage becomes an infrastructure threat. If the government starts buying silver to stockpile it, that's game over for bears, because now you're competing with essentially unlimited fiat capacity. I don't think it's likely near term, but it's on the table, especially if credibility collapses and the government wants a dramatic signal. Now let's talk supply. Silver is unique because it's both a monetary metal and an industrial metal. Roughly half of demand comes from industry. Electronics, solar panels, medical devices, water purification. The other half comes from investment and jewelry. In an economic slowdown, industrial demand should drop. That's bearish. But in a monetary crisis, investment demand can surge. That's bullish. The question becomes, which force dominates? Right now, investment demand looks like it's overwhelming any slowdown concerns. But watch the solar industry. Solar panels use silver paste in photovoltaic cells. A solar boom tightens supply further. A slowdown frees up silver. Either way, the market's balancing act is fragile. Mining matters too. Silver is mostly mined as a byproduct: copper, lead, zinc, gold. Only about 30% comes from primary silver mines. That means supply isn't very responsive to price. Even if silver doubles, you can't open new mines overnight. Mines take years to develop. That supply inelasticity is bullish when demand surges, because supply can't quickly ramp. So price has to do the work. It rises until marginal buyers drop out. And in a monetary crisis, that clearing price could be much higher than people expect. I want to give you one more historical comparison. Weimar Germany, 1923. Hyperinflation, currency collapse. People burned money for heat because it was cheaper than firewood. In that world, physical goods become the store of value. Silver, gold, real assets, tangible things. The US is not Weimar Germany, not yet, but the loss of confidence in the Fed is the first step down that path. If people stop believing the Fed can control inflation and protect dollar stability, demand for hard assets accelerates. Silver, because it's more affordable than gold, becomes the middle-class vehicle of choice. That's the demographic driving this, not just the ultra-rich. They're buying gold, art, real estate. It's the middle class with $50,000 or $100,000 in savings, terrified of it being inflated away. They can't buy 10 ounces of gold at $4,600 each, but they can buy silver. It's accessible, it's tangible, it feels like insurance. Now consider what happens if the Fed pivots and cuts rates. Let's say the DOJ investigation fizzles out. Powell survives, the Fed cuts rates to juice the economy. In a normal world, that's bearish for the dollar and bullish for silver. But we're not in a normal world. If the Fed cuts rates after a credibility crisis, it can look like surrender. It can signal weakness, not control. And that perception could intensify the flight to hard assets. So even a dovish pivot could send silver higher. That's the trap. Hike, cut, hold. Every option has consequences when trust is damaged. Here's my forecast for the next 3 months. Expect volatility. Sharp moves up, sharp moves down. Comics may hike margins. Media will call it a bubble. Retail panic sells. Institutions buy dips. Then price rips again. By March, spot could test $100. By April, premiums may compress slightly as dealers catch up if they can, but the $100 floor for Eagles could remain sticky. And if the DOJ investigation stays active, I expect another wake-up move. Maybe 120, 135 physical, maybe 150 plus. The real risk is a black swan, something nobody priced in. A war, a debt crisis, a currency collapse outside the US that triggers contagion. If that happens, all bets are off. Silver could go to 200. You could also see emergency orders, capital controls, export bans. There's precedent for that. In 1933, the US government banned private ownership of gold. Could they try something similar with silver if they feel threatened enough? I don't think it's likely, but I'm aware of the risk. That's why I don't have all my net worth in silver. Diversification still matters. I have some gold, some cash, some real estate. Silver is my crisis hedge, not my entire portfolio. Now let me talk about the psychological warfare you're about to experience. Financial media will try to break your conviction. They'll bring analysts saying silver is overvalued. They'll show charts with bearish technical patterns. They'll interview people who bought at the top in 1980 and lost everything. The message will be simple. Don't be that guy. Sell now. You need to decide right now whether you're trading or holding. If you're trading, you need stops and profit taking. If you're holding as insurance against systemic breakdown, you have to ignore the noise. You can't do both. You can't say, I'm holding for the apocalypse, then panic sell on a 10% pullback. I'm in the holding camp. I'm not trying to time every swing. I'm trying to survive systemic stress. That means I accept volatility. I accept temporary drawdowns because I'm not measuring success in dollars. I'm measuring it in ounces. If I have 100 ounces today and I still have 100 ounces next year, I won. The dollar price becomes secondary if the dollar itself is the problem. Now let me give you, here's a thought experiment. Imagine silver hits $150 spot. At that point, people start melting old silverware, jewelry, anything with silver content, recycled supply floods in, dealers suddenly have inventory, premiums compress, price stabilizes. Is that the top? Or is it just a pause before the next leg up? I don't know. But I do know $150 is a psychological level where behavior changes. Below it, silver feels expensive but normal. Above it, it starts feeling like bubble territory. And bubbles attract attention. Media, regulators, politicians. Once silver becomes a political issue, the dynamics change. That's why I have triggers. I'm not married to silver. I'm married to the mission. Preserve wealth. If the strategy says sell, I sell. If it says hold, I hold. I don't let emotion or ego drive decisions. Let me also address counterfeit risk. As price rises, counterfeits become more profitable. Fake coins, fake bars, tungsten-filled fakes that pass weight tests, but fail purity tests. This is already a problem in gold, and it's coming to silver too. How do you protect yourself? Buy from reputable dealers, get a Sigma metalytics tester if you're buying large quantities, or pay for assay services. It costs extra, but it's worth it. The last thing you want is discovering your stack is fake when you try to sell. I've seen estimates that 5% to 10% of physical precious metals on the secondary market are counterfeit. That's terrifying. It means buying from random individuals, Craigslist, or sketchy shops carries real risk. Stick with big players, pay the premium, sleep better. Now let me tie this together. The DOJ investigation into Jerome Powell is not just a political scandal. It's a credibility crisis. It's the moment the curtain gets pulled back and the wizard looks like a man. The Federal Reserve's power has always been based on perception. The perception they're independent, competent. Above corruption, above reproach, that perception is cracked. When perception breaks, price discovery gets chaotic. Assets that were overvalued can crash. Assets that were undervalued can reprice violently upward. Silver was undervalued for decades because the paper market suppressed the price. The physical market is now correcting that suppression. $100 isn't the top. It may be the start of a repricing. I've been in this market for 12 years. I've seen rallies and crashes. I've made money and lost money, but I've never seen a setup like this. Fundamentals, technicals, sentiment, geopolitics, everything is aligned for a sustained move higher. That doesn't mean straight up. It means the trend is your friend until it isn't. My personal battle plan is simple. Hold the core position, trade around the edges, take profits on volatility, reinvest on dips, stay disciplined, don't get greedy, don't get scared. This is a marathon, not a sprint. Here's my rallying cry. We are witnessing the death of central bank independence in real time. The Fed opened Pandora's box thinking the illusion could last forever, but the DOJ just called them on it, and the physical silver market is the canary in the coal mine. It's telling you something is broken. It's telling you the paper game is failing. It's telling you that if you want protection, you need something real. Don't let the screen lie to you. The screen says $85. The dealer says $100. The dealer is telling you the truth. The screen is telling you a fairy tale. Trust physical reality. Trust the signals. Inventory drying up, premiums exploding, restocks failing. If you ignore that because TV says everything is fine, you may be left holding paper when the music stops. Things are moving too fast to wait for next week. The landscape shifts daily. You need historical context to see where this could go. I covered the 1980 Hunt Brothers squeeze in a previous video. That's part of the playbook the system might use to try to stop a rally like this. If you haven't watched it, go find it. Because the strategies used then are the strategies they reach for now. Except this time, buying is decentralized. This time, demand is global. This time, they may not be able to stop it. The clock is ticking, the physical premium is widening, inventory is shrinking, institutions are positioning, and the retail wave might not even have started yet. You're early, you're ahead of the curve, but staying ahead requires action and understanding, not passive scrolling. I know where I was. Watching the data, reading vault reports, talking to contacts on institutional desks, buying physical silver while premiums were still manageable. And I'm sharing this because I believe retail investors deserve the same kind of information institutions get. We're not second-class citizens. We're not dumb money. We're people trying to protect what we earned. So that's the full picture. The DOJ opened Pandora's box, physical silver decoupled from paper. $100 is the new floor for Eagles. The premium gap is real and widening. The historical playbook says the system will try to intervene, but this time might be different. The math says higher prices are possible. The sentiment says the retail wave hasn't fully arrived yet. So my plan is to hold the core, trade the edges, stay disciplined, stay sharp, stay informed, and trust the physical reality over the paper illusion. I'll see you in the next one. Let me know in the comments below. If the screen price and the real world price keep diverging, what do you think that says about who's actually in control of price discovery now?